Hi everyone, I am Dr. Soundararaj. I am happy to interact with you all through this video. In this video, I am going to explain yet another problem on preparation of a cash flow statement under indirect method of accounting standard 3. These are all a few details related to me. These three subjects are my area of specialization in teaching and research. After you watch the full video, if you like the video, give a like to the video and do subscribe my channel so that you get the updates of the new videos that I will be releasing. Let's get into the problem. From the following balance sheets of Collins Company Limited, prepare cash flow statement. The balance sheets are given for 2 years. The first year is 2019 and the second year is 2020. Therefore, the current year in this problem is 2020. You are given with items like equity share capital, shares of 100 rupees each, opening balance 4,50,000, closing is 6 lakh rupees. You find an increase of 1,50,000 rupees in the value of equity share capital. You also find a new item in the current year, that is a securities premium amounted 15,000 rupees. Therefore, additional issue of shares for the value of 1,50,000 rupees has been made at a premium of 15,000. So, the cash inflow through financing activities in this regard is 1,65,000. 1,50,000 of capital value plus the securities premium of 15,000, it comes to 1,65,000. It would be recorded under financing activities of a cash flow statement as per AS 3. Profit and loss appropriation account opening 60, closing 60. You are given with the profit for the year separately. It is amounted 50,000 rupees. 8% debentures opening value 2,50,000, closing is 2 lakh rupees. Therefore, they have carried out redemption of debentures to the value of 50,000. In that they have earned a profit of 1,000 rupees which is kept separately. Therefore, they have redeemed the debentures worth of 50,000 rupees, making a payment of only 49,000 and they have earned a profit of 1,000. So the 49,000, which is a cash outflow for the redemption of debentures, will be taken over to financing activities and recorded there. Sundry creditor is a current liability. You find decrease in sundry creditor. Decrease in the current liability leads to cash outflow. Provision for taxation 40,000 rupees, 50,000 rupees. We will open a separate ledger account for it and decide how to go about. Proposed dividend 45,000, 60,000. And I call upon the attention of the learners in this regard. From 31/3/2016, a new recommendation regarding proposed dividend has been made. The companies are advised not to present proposed dividend in the balance sheet from 31/3/2016. It is with the assumption that dividend could be declared and approved only after the accounts for a current year is closed. For example, if the accounts are closed on 31/12/2019, the proposed dividend could be approved and paid only after getting the consent or approval of the board of directors through AGM. Therefore, it is recommended by the statutory bodies that treating this item as a subsequent item which is taken place after closing the books of accounts at the end of the financial year, it is done. So this could be written as a note to the financial statements and it should not be taken over to balance sheet. This is a new method. With regard to the new method, CBSE of India recommends that the dividend proposed for the previous year, with the assumption that it could have been proposed only during the current year but related to previous year, because in the current year only AGM will be convened for the previous year to approve the dividend of the previous year. That is the assumption of the body of people in CBSE of India. So with that assumption, the last year proposed dividend is added with the net profit of current year to calculate net profit before tax and extraordinary items. And the same amount is considered as cash outflow through financing activities in the current year. What about the proposed dividend for the current year? They just ignore it. This is a new treatment being followed by CBSE. Of course, I am not convinced with this particular treatment. As an academician, that's a different story. What about ICAI? I noticed that they simply give only one amount of dividend proposed and paid. That's for the current year. They have not spoken about the dividend for the previous year, nothing doing. Dividend proposed and paid. It is kept as a note outside the balance sheet. Therefore, it is very simple for the students to understand that this one amount which is given as proposed or declared and paid, that could be added with the net profit to calculate net profit before tax and extraordinary item, and the same amount could be written as cash outflow through financing activities in cash flow statement. So problem is very simple with regard to the procedure being followed by the Institute of Chartered Accountants of India. For the attention of the plus 2 students of the CBSE, I recommend that if you find dividends for 2 consecutive years presented in the additional information, it is a non-adjustment item, and therefore if you find such a situation, take the previous year proposed dividend, you add it with the net profit to calculate net profit before tax and extraordinary item, and the same could be recorded as cash outflow through financing activities. Just ignore the dividend for the current year. But what about the practice being followed at the college levels in India? Fine. Normally we find the proposed dividend given here in the balance sheet. Of course, it should not happen from 31/3/2016. If you find proposed dividend presented in the balance sheet following the old format, this is what you need to do. What is that? The 45,000, which is a proposed dividend for the previous year, should be assumed as paid during the current year. So take it as cash outflow through financing activity. What about the 60,000 rupees proposed dividend for the current year? It is a dividend amount to be added with the net profit to calculate net profit before tax and extraordinary item. This is what treated as an extraordinary item, the 60,000 rupees in this particular format, and this is a old format as well. So you can follow this old format with regard to this particular problem. My explanation is meant for the learners who are watching the video but doing different programs like studying plus 2 under CBSE stream, studying a degree, bachelor degree or master degree in the institutions affiliated with various universities of India. Then what about the students who are doing professional courses? So I have given the explanation meant for different groups of people. You choose whatever applicable to you. That is what my suggestion with regard to the treatment of proposed dividend. Fine. Come to the other point here. Plant and machinery cost value is given, accumulated depreciation, opening and closing balances are given, and you arrive at the book values of plant and machinery. Land, you find increase in the value of land, which is nothing but purchase of land. So you can take it as a cash outflow under investing activity of cash flow statement. Loan given to a subsidiary company is also assumed to be an investment. It was 25,000 in the beginning, now it is nil. That means what? We have recovered back the loan from the subsidiary company. So you can write it as what? Cash inflow under investing activity in the cash flow statement. Shares in subsidiary company, opening 30,000, closing 40,000. Therefore, we have bought additional shares worth of 10,000 rupees in the subsidiary company. So this is a new investing activity. So take the 10,000 rupees cash outflow to the investing activities of cash flow statement. Inventory is a current asset, sundry debtor is a current asset, and the bank balance, this is what cash and cash equivalents with regard to this problem. Opening 60,000, closing 98,000 rupees. As I keep on saying in all videos related to the preparation of cash flow statement, the very purpose of preparing cash flow statement is to know the reason why the opening balance of cash has become this much of closing cash balance, cash and cash equivalents balance. So in this problem, how the 67,000 rupees opening cash balance has become 98,000 rupees, we will find out the reasons for this particular change. Let's go through the additional information. During the year, plant costing 40,000 rupees was sold for 15,000. Accumulated depreciation on plant was 20,000 rupees. It means that a plant costing 40,000 rupees, accumulated depreciation of 20,000 rupees is there. Therefore, the book value of the plant sold and the rate of sale should be 20,000. It is sold for 15,000. Hence, they have incurred a loss of 5,000 rupees in the sale transaction of a plant. Loss on sale of plant was charged to profit and loss account. That's a normal procedure that has been taken place here also. Tax paid during the year was 55,000, and therefore definitely, as I suggested, we need to open a ledger account for a provision for taxation. Let's get into the ledger accounts one by one. We will first go through the accumulated depreciation account. That's an account you need to normally open if you find accumulated depreciation in a problem. This is being a credit balance. Opening is written in the credit side, closing is written in the debit side. As we have suggested that the accumulated depreciation on the plant sold is 20,000. So what is the journal entry for it? Accumulated depreciation account debtor to plant account, or you can write to plant disposal account, because here in this problem they open a separate account meant for plant disposal. That's a good procedure. So we will look at the details of plant disposal next. So plant disposal account 20,000 rupees. The reason for this particular entry is nothing but if an asset on which accumulated depreciation is maintained is sold, the accumulated depreciation on the asset sold should be removed from the books of accounts, and that is what happened here. This 20,000 is the accumulated depreciation on the plant sold. The moment the plant is sold, the corresponding value of the accumulated depreciation should also be removed and closed, and that's the idea. So from 1,20,000, if you deduct 20,000 rupees, what is the closing balance expected to be? It is only 1 lakh. But what is the actual closing balance accumulated depreciation account? It is 1,45,000. Therefore, you find an increase of 45,000 rupees in the accumulated depreciation on plant account. That's nothing but current year provision for depreciation. What is the journal entry for making provision for depreciation in the current year? Adjusted profit and loss account or statement of profit or loss debtor to accumulated depreciation or provision for depreciation on plant account, and that is what this 45,000 rupees. This is a hidden information we have come to know preparing this ledger. Now let's get into the plant disposal account. As I said, the cost value of the plant disposal should be separated and transferred to an account called the plant disposal account. What is the journal entry for it? Plant disposal account debtor to plant account. If you credit plant account, the debit balance in the plant account will come down. By virtue of that, we create another account named plant disposal account. So plant disposal account debtor to plant account 40,000. What is the journal entry, combined journal entry for the sale of plant? Bank account debtor, it is sold for 15,000. So bank account debtor 15,000. Accumulated depreciation account debtor 20,000. Adjusted profit and loss account debtor 5,000 to plant disposal account. This is the combined journal entry for sale of plant in this problem. So you have posted the journal and this account is tallied. Now let's go to the third account in our discussion, which is nothing but plant account. This is being an asset. You write the opening balance in the debit side, closing balance in the credit side. Opening balance 6 lakh rupees. Closing balance 7,25,000 rupees. Now you remove the plant disposal cost value of 40,000 from 6 lakh. The closing is supposed to be 5,60,000 only, but the actual closing is 7,25,000 rupees in this account. So the increase in its value is because of purchase of plant. So to bank account purchase, which is the balancing figure, it comes to 1,65,000. What is the real journal entry for purchase of plant using cash? Plant account debtor to bank account. So with that, this account is also closed. Now let's go to the provision for taxation account. Provision for taxation being a credit balance, the opening is written in the credit side. By balance brought down, to balance carried down. You can even remove the terms like by, to and all. Now that is what suggested by the professional bodies. So you can write balance brought down here, balance carried down in the debit side. Now my point here is, through the additional information, we were informed that tax amounted 55,000 rupees has been paid by the company during this year. What is the journal entry for making payment of tax? Provision for taxation account debtor to bank account. To bank means what? When cash goes out, it has to be credited. Right. So to bank, this is for paying tax during the current year. Now look at the balancing figure in the problem. It comes to 65,000 rupees in the credit side, which is nothing but new provision for tax made during the current year. The journal entry for it, statement of profit or loss or adjusted profit and loss account debtor to provision for taxation. When you credit provision for taxation, which is originally a credit balance account, so further it would be increased. This is an idea of this particular journal, 65,000, it is closed. This 65,000 is a figure to be adjusted with net profit to calculate the net profit before tax and extraordinary items. Now let's straightly move to the cash flow statement. What is this net profit before tax and extraordinary item, which is the first item written under cash flow from operating activities? It comes to 1,75,000. How it could have been calculated? Now please have a look at what I say. The current year profit given in the problem is 50,000. With that 50,000, what is to be done? The tax provided during the current year, it is amounted 65,000. Now look at it. 50,000 plus 65,000 is a provision for taxation. Plus 60,000. What is this plus 60,000? That is an extraordinary item, which is nothing but the dividend proposed for the current year. Look at the problem. The dividend proposed for the current year is 60,000 rupees. If you follow the new format, definitely this item will not appear in the balance sheet. It will be written as a non-adjustment in the additional information. So the treatment is different that I have explained. But in this problem, since they have given the problem in the old method, I am also following the old treatment with regard to proposed dividend. So this 60,000, which is a proposed dividend for the current year 2020, has to be added as an extraordinary item to calculate net profit before tax and a extraordinary item. This is how this figure has been calculated. Now you do adjustment for either non-operating or non-cash items. The accumulated depreciation provided is 45,000 rupees during the current year, and that is what added here. What about the loss on sale of plant? This is another item, 5,000 rupees loss on sale of plant, which is adjusted with the statement of profit or loss, and this particular 5,000 rupees is also added because this is a non-operating item and this is a depreciation is a non-cash item. Based on these reasons, only these two figures have been added. And there is no other non-operating income in this problem, so let us not worry about such other details. Now they have calculated operating profit before working capital changes amount to 2,25,000. With that, you do adjustments for changes in current assets and current liabilities. When you do this particular step, you try to recall the four formulae which I keep on explaining in all the videos. 1. Increase in current asset leads to cash outflow. Decrease in current asset leads to cash inflow. Increase in current liability leads to cash inflow. Decrease in current liability leads to cash outflow. I have very clearly explained the basis by which I have come out with the four formulae. Please watch my previous videos on the preparation of cash flow statement. I have given the links for those videos in the description of this video. Do watch those videos also. Cash generated from operations, it comes to 1,65,000. With that, you deduct tax paid. Tax provided was added over there to calculate 1,75,000. Here tax paid is subtracted. Now finally they have calculated net cash from operating activities amounted 1,10,000. Cash flow from investing activities, sale of plant 15,000. Yes, we remember a plant costing 40,000 rupees was sold for 15,000. Here the sale proceed is recorded as cash inflow. Let's not worry about the loss incurred in this transaction in this stage. Purchase of land 15,000, I explained it when I took you through the problem. You find the land value is increased by 15,000. Therefore, this is nothing but purchase of land. Purchase of plant that we found out by preparing the plant account. We learned that a plant worth of 1,65,000 rupees has been purchased during this year. So it is a cash outflow. Purchase of shares in subsidiary, I very clearly explained when I explained the items of assets in the beginning of this video. This 10,000 rupees is cash outflow through investing activity. Loan recovered from subsidiary company, it was 25,000 rupees in the opening. In the closing it is nil. Therefore, we have got the loan amount back from the subsidiary company. So that is nothing but cash inflow here. Finally, we have calculated net cash used in investing activities because this is a negative figure, 1,50,000 rupees. The third category of cash flows is named cash flows from financing activities. Issue of equity shares including premium. I explained this concept very clearly in the beginning of the video. You find an increase of 1,50,000 rupees in the value of equity capital. In addition to that, you find an increase in the securities premium amounted 15,000. Now this is to be called only as securities premium, not share premium. The days have gone. So 1,50,000 plus 15,000 put together, 1,65,000 is a cash inflow through this financing activity. Redemption of shares have been carried out for a value of 50,000, but the cash payment made is only 49,000. How do I say that? Yes, the company has earned a profit of 1,000 rupees in the redemption of debentures. Therefore, instead of paying 50,000, they would have paid only 49,000, and the amount paid is finally recorded as cash outflow through this particular activity. Payment of dividend. This is a dividend proposed for last year, and that has been recorded here. If you follow a new format, the amount should be the same both in this stage when you calculate net profit before tax and the extraordinary item, and the same has to be subtracted here. Fine. Net cash from financing activities comes to 71,000 rupees. So if you add these three items, 1,10,000 positive figure, 1,50,000 negative figure, 71,000 rupees positive figure, you get net increase in cash and cash equivalents for the current year amounted 31,000. With that, you add the opening cash and cash equivalents, the amount at 67,000, you get the final answer of 98,000 rupees here, which is nothing but cash and cash equivalents at the end of the current year 2020. Please look at it in the problem. See, 98,000 rupees. I hope I have explained the points very clearly in this problem, and more specifically, I have made my explanation very clear with regard to the treatment of proposed dividend in various exams. So the listeners, you try to understand or pick up my explanation with regard to the course, what you do, and treat proposed dividend accordingly in preparation of cash flow statement in your examinations. All the best. We will meet in the next video that will also be on cash flow statement. I will meet you with another problem, a new problem related to cash flow statement. Thanks again.